So you have a big purchase coming up. You might have a car, you might have a wedding, you have something on the horizon that you know you're going to need their money for in just a few years. So how do you invest it? Can you invest it? What should you do with that money in the interim? We'll discuss those options with Mike Coynan starting now. Well, glad to have you on Retirement Reality. I am Ben George with Mike Coynan of Principal Preservation Services. Mike, this is a very specific investing topic, but I think a good one because we all have big expenses on the horizon, and I'm in the same boat. I know I want to use this money at some point, probably pretty soon in the next 2 or 3 years, but also don't want to just stick it in the bank and earn very little money on it. So what do you do in the meantime? This is an important discussion you got to have with people, right?
We do, and there's pros and cons by investing that money, in the bank or putting it in the market or just sitting on it. So, I want to talk about those because sometimes it might be, as much as we don't want to have it not earning enough, that might be the best thing to do if you need that money guaranteed in the next 3 years or sooner.
And there are some big things that come up, right? I know. Could be a car, could be a wedding. I know you've had a few of those that you've had in recent years to prepare for. A new house. I know a lot of people are probably sitting on a mortgage that they maybe want to get into a new home once the mortgage rates drop a little bit. There's a lot of reasons why you might have that money earmarked, but that kind of horizon 2 to 3 years, is that a pretty good kind of time frame where anything within that window is where you kind of want to rethink what you're doing with it?
Yeah, I have an example of a couple who sold their property and they're sitting on cash, and then they're going to rent for a few years, buy a piece of land, and then build on it. So it was a couple-year project. And when we met them, they put their money in the market with somebody, and we were told that was the best place to have that money grow. Well, it was a bad time. I think that was 2018, and the market was dropping in 2018 at the end of the year, and they took the money that they were using to build a house that was losing money. And that was stressful to them, super stressful. So you have to understand, what is the purchase? Can you afford any risk? Because it's not a guarantee you put it in the market that it's going to only go up, right? So whether it's a house, a car, college education, whatever that might be, we have to kind of measure the upside risk and the downside potential as well. Downside risk, upside potential, is that worth it for you to be in the market? In my opinion, if it's within 3 years or less, that's a lot of things can happen in that time frame. Even if in that first 6 months or a year, the market goes down, you might not have that money recover before that 3 years are up. So the key is you want to make sure, in my opinion, that money should be a little bit safer and more guaranteed, to take that money off the table for the risk side.
Yeah. Is it important just to kind of get a very small return, Mike? I guess, right now you can get, around 3 to 4% on safe money. Is that a good enough return in the interim just to make sure that money is not really at risk of the market?
In my opinion, yeah. If you're getting something, I think that's better than just sticking in at some of these bank accounts that are paying zero interest on there. Even Charles Schwab, they have a money market that's paying about 4% today still. There's money in certain banks, online banks that are still FDIC insured, 4.25%, 4.5%. So even with the Fed's dropping rates, they're still decent. So if you can have that money make some interest, because if you don't, if inflation is, let's just say it's 3% a year, which is on the low end, it's been a lot higher. If you put, let's just say you need it for a house built, and you put $500,000 in the bank, so that means you need to be making about $50,000 of interest to make sure it's worth that same value 3 years later, right? So how are you going to do that if you're not making interest? Your $500,000 is worth maybe about $450,000 in 3 years. So you haven't kept up with inflation. So I think there's a lot of things to look at. I'd be happy to get a 4% return today on money that's guaranteed to be there, rather than you put $500,000 and it could be 400,000, 450,000 in 3 years. It could be 600,000. We don't know, but you have to measure the risk reward, right?
What other options do you have then, Mike? I know, obviously the bank or just sticking in a money market fund is going to be probably the most common choice for someone. But what other conservative options, are on the table potentially if you have this money to set aside for a big purchase, but you do want to maybe try to get a little something.
Right. For those clients, what's not in the bank, a lot of times we can do a fixed account, a fixed annuity for like 3 years. Right now, you can get right around a 5% return on a fixed annuity, and that is guaranteed every year. They pay a little bit better than what banks pay, and you get that interest every year. After the 3 years are up, it's 100% liquid, but at least you knew you made that fixed rate for those years. You can do, a 2 year or 3 year or 5 year, whatever that time frame is. That's one place to put it. The other place is we have option to offer structured notes to our clients. So a structured note is like a CD, but they're not insured like a CD. But the upside potential could be better. You might be in that 6%, 7% range on average. But the downside risk, a lot of the ones we do have zero losses. So worst case, you can't lose. Best case, you make better than what a fixed annuity would be or a CD would be. So those are options that we have available to help our clients. We can do a short term, we can do a year and a half, 2, 3 year. We can ladder them out as well. These are options that we have that a lot of advisors don't have.
Yeah, I like those. How do you help determine what's best for someone when they meet with you, Mike? Is it just kind of their appetite for risk, or is there another kind of formula that you use to figure out the result?
Yeah, risk is a big part of it. And again, the time frame. Some might be less than 3 years, some might be longer than 3 years, or right around there. So if it's less than 3 years, we probably look at maybe a structured note that might be a year and a half, 2 years. Make sure it doesn't go longer than that. If it could be 3 years at the shortest, the soonest, or it could be maybe 4 or 5 years, then maybe we'll look at a fixed annuity with those guarantees. And it again, depends on their risk tolerance. But with those structured notes, we love doing those for clients because the market's been strong. Clients are making some good returns. Worst case, they don't lose anything, and they just have to understand they can make potential for gain, but they can't lose in the downside. Worst case scenario. So risk is a big part, and timeline is the second part to that puzzle.
Tremendous. Well, if you have money to invest, but you're going to need it in a few years, now is the time to sit down with someone to figure out what these options might be best for you. You want to be getting something out of it, but you want to make sure you're protecting yourself. You don't want that money to lose a lot of value in the interim, so that you don't have what you need when that expense arrives.
One more thing on those notes too, they're designed a little bit different. Some they pay the interest at the end of the term, whether it's a year, 2 years, 3 years, or so on. Some are paying monthly interest. So we've had clients like even in 2022, when the markets weren't strong, the markets were a negative market, or clients made positive returns in that year because as long as the market doesn't drop too much, they still get monthly interest. And they're all structured differently. But we had clients who were making, 8, 10% in 2022 when the markets were down as far as 25%. So you can still make interest in poor markets by having some of these structured notes as well.
Yeah, that's interesting. Thanks for kind of sharing that. And if you want to learn more about that, please don't hesitate to reach out, 855-987-8888. All right, please subscribe to the show if you haven't done that already. The channel, we have videos coming every single week to try to educate and inform you. If you have any questions as well, please reach out. Be happy to talk to you again soon. Mike, take care. Have a good week.
Thank you, Ben.
Investment advisory services offered through Alpha Star Capital Management, LLC, an SEC-registered investment advisor. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. Alpha Star, Principal Preservation Services, LLC, and Principal Wealth Services, LLC are separate and independent entities. Insurance products are offered through Principal Preservation Services, LLC, a Minnesota and Wisconsin insurance agency. Investment advice is offered through Principal Wealth Services, LLC. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products offered by Principal Preservation Services, LLC. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered or guaranteed by Alpha Star.